Welcome to the Deep Dive. This is where we cut through the noise, get straight to the insights from research that really matters. Today, we're plunging into two really compelling sets of sources. Our main focus, it's this comprehensive economic analysis called the Silicon Leviathan, an economic analysis of the AI infrastructure boom and its historical parallels. And our mission for this deep dive is pretty clear. We're going to unpack the just unprecedented scale of capital expenditure CapEx, flooding into AI infrastructure right now. We want to understand its impact on the macroeconomy and critically look at the unique, maybe even a bit unsettling risks involved. So you'll walk away with a much clearer picture of what's really driving a big chunk of the economy. And while thinking about the future, all this AI infrastructure needs skilled people, right? To build it, to use it. Which brings us nicely to our second source, AI Unraveled, sponsorship and certification opportunities. It gives us a crucial look at the wider ecosystem supporting this whole AI revolution.
Yeah, it's a great complementary piece. Really shows you the human capital side, beyond just the hardware investment.
Okay, so let's dig in. The sheer mind-boggling scale of this current AI infrastructure boom. The headline figure, annual investment in AI data centers, related hardware. It's hit about $520 billion. Just think about that number. To put that in context, that's equivalent to roughly 1.73% of U.S. gross domestic product, GDP. And this is a huge expansion from before 2022 when AI CapEx was like less than 0.1% of GDP. We're talking an almost 18-fold jump in just a couple of years.
Yeah.
It's wild.
It is wild. And what's really striking me, compared to the economy's size, that level of spending, it already surpasses the peak of the telecom infrastructure build-out back in the dot-com era. And it's actually getting close to a meaningful fraction of the 19th century railroad boom, which that really tells you something about how significant this moment feels.
It's almost dizzying, isn't it? Thinking about that much money pouring into one single sector, the scale is just unprecedented. And what's fueling this whole wave, the source calls it the hyperscaler arms race. These are the tech giants just throwing incredible sums into building out AI-enabled data centers, Microsoft, for instance. Public plans for around $80 billion in their fiscal year 2025, and their quarterly spending's ramping up, so they might even blow past that.
Right.
Then you've got Amazon. They look like they're on track for over $100 billion in 2025, mostly for AWS, for AI workloads.
Oh, over $100 billion.
Yeah, and Google, Alphabet, right. They just upped their 2025 CapEx guidance by $10 billion, now up to $85 billion.
Just because of demand.
Demand is clearly surging. And Meta, they raised their 2025 forecast too, somewhere between $66 and $72 billion. Similar growth expected in 2026. So just those four companies, that's over $330 billion combined annually.
And that's probably conservative, right?
Oh, yeah, absolutely. That's a baseline. It doesn't even include Oracle, Apple, or those specialized AI cloud providers.
That concentration is, well, it's really something. All this capital funneled through just a handful of private companies. That's what makes this moment historically pretty unique. And if you look at NVIDIA, they're really the bellwether here, aren't they?
Definitely.
They supply, somewhere between 70% and 95% of the AI processors for data centers. So their financials are a critical proxy for the whole ecosystem. Their fiscal 2025 data center revenue was, get this, $115.2 billion.
Wow.
Yeah, 142% increase from the year before. So if you kind of extrapolate from that, assume NVIDIA's hardware is, say, 25-35% of total AI data center CapEx, including construction power, cooling, all that stuff.
Normal build-out costs.
Exactly. Then NVIDIA's revenue implies total ecosystem spending somewhere between $384 billion and that analyst estimate of $520 billion, which really highlights a big systemic risk, doesn't it? This whole silicon stimulus is incredibly dependent on one company's execution. There's dominance, there's stability. Any hiccup with NVIDIA could seriously dampen this whole CapEx wave.
So when the analysis talks about a structural shift and maybe speculative bubble characteristics, what does that really mean on the ground? What's a key sign beyond just the raw numbers?
Well, I think one thing that jumps out is how much of this investment feels anticipatory. It's a huge bet on future demand for AI, demand that hasn't actually fully materialized yet.
Build it and they will come.
Exactly, on a massive, unprecedented scale. So this rapid expansion, it signals a real structural shift in how capital is being allocated, huge consequences. And it creates this self-reinforcing feedback loop, which, as the source points out, kind of hints at classic speculative bubble stuff.
But to really get a handle on the magnitude, we need to look back, right? How does this AI boom stack up against past transformations? Like, say, the railroads in the 19th century. What can history teach us here? Let's dive into that. The 19th century railroad boom. Now, it's important to be clear here. Peak railroad investment, like in the 1850s, that was maybe 15–20% of total capital investment in the country, not GDP itself.
Right, different denominator.
Exactly. A more accepted number for sustained railroad investment as a share of the whole economy, the GDP, was probably more like 5%, 8%. But even at that level, the economic impact was just monumental. It completely shattered barriers of time and distance, created a truly national market. And the estimates are that it contributed something like $4.20 in accumulated GDP growth for every single dollar invested.
Wow.
Yeah, an incredible 43% social rate of return, meaning the benefits to society, new markets, productivity gains went way beyond just the direct financial returns to the railroad companies.
And a really key difference with the railroads, though, was how they were funded. It was a massive public-private partnership, wasn't it? Something like half the capital for the big interstate railways came from federal land grants, basically a direct public subsidy.
That is a huge contrast to today. Okay, let's shift to a more recent parallel. The dot-com era's foundation, the big telecom buildout. At its peak, around the year 2000, telecom capex hit about $120 billion. Now, if you calculate that against the US GDP back then, which was about $10.25 trillion, that $120 billion comes out to roughly 1.17% of GDP.
Right, and this is where the comparison gets really sharp, because the current AI infrastructure spending at 1.73% of GDP, that's nearly 50% larger relative to the size of the economy, then the telecom build-out was at its absolute peak.
50% larger, wow.
Yeah, and if we connect this to the bigger picture, there are some really profound qualitative differences between these three booms, right? The investment case for railroads, moving physical stuff, and for fiber optics, moving information, it was tangible. You could grasp it. Yeah. But this current AI build-out, it's much more abstract, isn't it? Creating non-human intelligence. The ultimate uses, the real ROI, it's still highly speculative. Which implies, a fundamentally higher level of uncertainty. And it also points to that profound shift in funding models we talked about. Railroads were kind of seen as a quasi-public good, lots of dispersed benefits, heavily subsidized, this AI build-out, driven almost entirely by a handful of private firms for their own strategic edge, which could lead to, really disproportionate economic gains for just those hyperscalers, more economic concentration.
So it's clear this AI capex boom isn't just some tech trend. It's acting like a de facto privately funded stimulus package for the whole economy.
Exactly. And that leads to this really crucial point the analysis makes. It's masking the cracks in the broader economy. Analysts calculated that for Q1 2025, without that AI data center investment, US GDP would likely have contracted by about negative 2.1% instead of the mild downturn.
Contracted. Okay, that's significant.
Very. And it raises a really important question. Are central banks, policymakers, maybe misreading the true underlying health of the economy because they're looking at these headline GDP numbers?
Right. Which could lead them to?
Well, potentially unwarranted tighter monetary policy, right? Because the economy looks stronger than it actually is underneath this AI boost. And if this AI stimulus were to suddenly slow down, that underlying weakness it's been hiding could just pop out very abruptly.
That's a powerful point about masking cracks. So if policymakers are potentially misreading things, what are the immediate, tangible risks we should worry about?
I think the most immediate risk is that they might tighten policy, raise interest rates, for example, based on an economy that looks robust but is actually being propped up by this very specific, very concentrated investment. And that could end up stifling recovery in all the other parts of the economy that aren't getting this AI boost.
Which leads right into this idea of the great reallocation of capital that's happening. Just look at venture capital. In 2024, AI startups apparently grabbed a full third of all VC dollars and almost half of the late-stage capital.
Wow, a third of all VC?
Yeah. Global VC funding for AI jumped over $100 billion. That's an 80% increase from 2023. Meanwhile, other sectors like fintech investment actually fell.
Yep.
And this flood of cash is distorting valuations too. AI startups are commanding these huge premiums, like a 15% increase in seed valuation compared to a 5% drop for non-AI
How
startups.
much?
Yeah. The source mentions VCs who are basically mostly only doing AI right now.
Yeah.
We're also seeing this internally at big companies, internal corporate reallocation. Companies like Amazon are rerouting budgets, personnel. There have been layoffs in some cloud divisions, reportedly because the AI build-out costs are just spiraling. And then in the wider economy, you get this crowding out effect. Other industries find it harder, more expensive to get funding, to find talent, because everything's being sucked into the AI vortex.
And this brings us right to that labor market paradox the analysis highlights. Despite all this massive investment, billions and billions, the net effect on job creation is surprisingly quiet, muted. You take a typical large data center represents billions in investment, right? Once it's up and running, it might only employ around 100 full-time staff. Maybe.
Only 100 people for billions invested.
Pretty much. So the paradox is, AI is actually contributing to job losses right now through that capital reallocation and corporate restructuring, before the technology itself has really started automating tasks on a wide scale. So you end up with this stimulus that's incredibly capital intensive, but not very labor intensive at all.
Which brings us to a really crucial distinction the analysis makes, the ephemeral nature of this AI infrastructure. Unlike those past booms, we're not talking about assets that last for ages.
Exactly. This is the depreciation dilemma. Think about it. Railroad rights of way. Those are assets that last for a century, potentially. Fiber optic cables have a passive lifespan measured in decades. But GPUs, specialized AI accelerators, the heart of this infrastructure, their effective useful life is maybe just 1 to 3 years.
1 to 3 years. That's barely out of the box before it's becoming obsolete.
Precisely. And due to a couple of things. Ferocious physical degradation. There's a reported 9% annualized failure rate for NVIDIA's H100s.
9% fail every year.
Apparently. And then there's just incredibly rapid technological obsolescence. The next chip generation makes the current one look slow. And this creates what the source calls a capital maintenance trap. Companies are actually reversing the old practice of trying to extend how long they depreciate servers for. Amazon, for instance, is now shortening the depreciable life of its AI servers from 6 years down to 5. They're admitting this stuff just doesn't last as long, which creates this perpetual CapEx treadmill. You have to keep spending massive amounts year after year just to stay current, just to maintain your position.
And we can actually see a cautionary tale playing out right now, can't we, in China? It provides a pretty stark, real-world example of these risks.
Indeed, it does. China has embarked on this global overbuild. Over 250 data centers under construction, largely pushed by state directives. But it seems to have led to this massive kind of dysfunctional overbuild. Reports suggest as much as 80% of the newly built computing capacity might be sitting idle.
80% idle.
That's the report. Problems seem to be poor planning, building facilities in remote areas where AI companies don't want them because of latency issues, things like that. The result? Distressed assets. Brand new multi-billion-dollar facilities struggling to find customers. It's apparently gotten so bad that President Xi Jinping himself has publicly warned against this spending rush, even threatening state intervention.
Wow.
So it really raises an important question. Could similar dynamics, maybe driven more by market mania than state directives, play out elsewhere, especially if the investment frenzy overrides careful planning?
And that leads to maybe the scariest consideration. When the spending stops, modeling the economic cliff. The sources basically sketch out a potential cascading economic crisis if these hyperscalers suddenly pull back on CapEx. Or maybe if some disruptive new technology emerges, that makes the current approach obsolete.
Yeah, the scenario is pretty grim. You'd get this sudden withdrawal of that silicon stimulus.
Yeah.
It would abruptly reveal the underlying economic weakness that the AI boom has been masking. Remember that potential negative 2.1% GDP contraction.
Right.
You'd likely see a market crash, especially for key suppliers like NVIDIA, and you'd be left with mountains of stranded assets, all this rapidly depreciating hardware with very limited secondary use, just a colossal malinvestment of capital.
Okay. We've spent a lot of time on the hardware, the massive capital flows, the big economic shifts. But like we said at the start, none of this infrastructure delivers any value without skilled people to build it, to use it, to innovate with it. And that brings us to this other really interesting layer of the AI ecosystem, revealed in our second source today, AI Unraveled.
That's right. It's a podcast hosted by Etienne Newman. The source describes him as a senior engineer and also a passionate soccer dad from Canada. It was kind of neat. And his show basically helps people get certified in AI. which is, a super crucial part of building up that human capital we need for this revolution.
Yeah, and it does it through really practical, accessible resources. Etienne offers these AI certification prep materials, study guides, audiobooks for the big cloud certifications, Azure AI engineer, Google Cloud generative AI leader, AWS certified AI practitioner, those kinds of things. You can find them on djamgatech.com or Shopify or Google Playbooks.
And he also offers something called the AI Unraveled Builder's Toolkit, which sounds pretty useful. Includes AI tutorials, PDF, audio, video formats, plus machine learning certification guides, all really aimed at helping people actually start building things with AI. And what's fascinating here, I think, is how this source really illustrates the broader economic activity swirling around AI.
Yeah.
It's not just about the giant hardware spend. It extends into these vital areas like, knowledge sharing, training, professional development, building the actual workforce that can leverage all this new infrastructure. It's the whole ecosystem.
Absolutely. It really paints the full picture. And for those of you listening who are AI innovators, tech leaders, maybe you're looking to boost your authority, reach a really targeted audience, AI Unraveled also talks about sponsorship opportunities. You can actually become a sponsored guest on the show, share your insights, talk about your latest projects, your vision for AI's future. They call it a thought leadership partnership. You can check that out and apply at djamgatech.com at Nash Unraveled. Seems like a really interesting channel for leaders in the space to connect with the people actually building this future. Okay, so to kind of wrap up our deep dive today, the core finding, I think, is that this AI boom seems to be two things at once, right? It's simultaneously a genuine technological revolution and a potentially speculative financial bubble. It feels like the revolution is being pulled forward, maybe even accelerated, by this speculative investment cycle.
Yeah, that sums it up well. And this has really distinct strategic implications depending on who you are. For investors, the big challenge is sorting out the short-term momentum from the actual long-term value.
Yeah.
You have to recognize those systemic risks. We talked about the supply chain concentration with NVIDIA, that capital maintenance trap, which is going to eat into future cash flows. Portfolios probably need to be stress tested against a scenario where this capex slows down.
Right. And for policymakers.
For policymakers, I think it's critical to acknowledge how dependent headline GDP figures have become on this very concentrated private stimulus. There's a real risk of making policy errors if you misjudge the health of the rest of the economy. And longer term, strategically, they need to think about the strain on resources, energy, water, and the importance of fostering a more resilient, diversified economic base beyond just this narrow boom.
Okay, and what about corporate leaders, say, outside of the big tech players?
Well, for now, they should probably anticipate continued constrained access to funding and talent for anything that isn't AI, as long as this boom lasts. But strategically, they should prepare for a future where computing power might actually become dramatically cheaper if there's some kind of bust or correction. That could really democratize AI access, create totally new competitive opportunities for firms that couldn't afford to play in this first super capital intensive phase.
So what does all this mean for the really long view? It seems like even if this current investment cycle does end in a painful correction, a bust, it's going to leave behind this unprecedented global stock of computational infrastructure.
An enormous amount of processing power.
Exactly. And this resulting surplus of potentially very cheap computing power could dramatically lower the barrier to entry for AI development down the road. It might actually become the foundation for the next unforeseen wave of innovation, built by new entrepreneurs, maybe smaller players, who can finally harness this abundant resource that the current giants paid so much to build. So maybe the final thought for you, the listener, is to consider how this potential legacy of the overbuild, how that might shape the world that comes next.